Ron, what do you do when the news flows like this?
Well, I think the most important thing is to take a long-term perspective and step back and think about what you want to own in the market and understand what the short-term movements can mean in terms of timing for you to get into new positions you might want or exit some other ones. But I think it's really important to zoom out and take everything into account in terms of the long-term and understanding what you're paying and what you're getting. But, there's always noise in the market. There's always volatility. And my view has always been that volatility creates opportunity.
Well, exactly. The volatility can be called a correction, and we're right there on SPX. I have to do the math. I believe we're at 9.5% down from the peak. Great. A correction is opportunity, but we freeze in our tracks in fear. Where is the greatest opportunity given this correction so I can unfear myself?
Well, I do think there's still downside ahead of us, actually. In terms of the backdrop for the fourth quarter, I think it's pretty challenging at this point. And admittedly, if we look at what happened over the weekend with the loss of Ruth Bader Ginsburg, truly a giant of the Supreme Court, I think the debate over that vacancy could suck what little oxygen was left in the room out of the room in D.C. And so, this is an increase in partisan animosity in the run-up to the election is probably an outcome of that. And if I think about that combined with a resurgent COVID pandemic in Europe, the arrival of flu season in the U.S., you've got quite a few things lining up against the optimistic view. And I do think, by the way, in terms of sucking the oxygen out of the room in D.C., the probability of another stimulus act probably is going down even more with this news. So with all that as a backdrop, I guess when I look at the market, I think what we saw in the last weeks and months was a speculative froth around some of the growth stocks in the market, in particular what we saw in August with retail buying significant amounts of call options, many of them literally with 1 or 2 days to maturity. They might as well have been playing the slot machine. We saw, I think, some of those signs of a kind of blowout top. And I think the growth stocks are probably particularly vulnerable, in particular those growth stocks where there's no current net earnings, there's no current cash flow. It's all a hope for the future. So I think that's where the downside risk is. But other parts of the market have been pretty much left behind in this rally. If you look at the S&P, we're still up year to date by about 3% pre-today's open, but the median stock's down 5%. So I think you can find some really high-quality companies with good current cash flow, decent earnings growth in the future, who just aren't in those kind of really exciting, frothy parts of the market. So that's where I would focus attention.
Ron, looking forward to what the next couple of months will bring, how much more volatility, how much more of a market correction could we expect?
Well, I was just looking through it this morning. The NASDAQ rose 82% from the bottom in March, on March 23rd, to the peak on September 1st. The S&P was up 63%. As Tom mentioned, with this morning's open, the S&P will be down just shy of 10%. We could easily have another 5 to 10% downside from here, if not even a bit more, depending on how the news flow comes out. I do think the market, I've said this before, and have been surprised at how resilient and strong the market has been. Many investors seem to have been extrapolating out a straight line of the improvement we saw from April to, say, July in the U.S. economy. And what became apparent last week with the FOMC meeting, I think, is that there was just an expectation that the Fed would always be there to provide the next round of liquidity to keep the high going. Well, it does seem like the dealer stepped away from the junkie this week, and maybe we'll have to sober up a bit in terms of the market.